Good morning, my name is Przemysław Kwiecień and you're watching XTB Weekly Trading Webinar. Today we are going to discuss about the US debt ceiling, and now there was a question, can US go bankrupt? So obviously it sounds scary, but we'll discuss this obviously in a context of the politics that can have some influence on the markets and will have some influence on the markets, and we will see to what extent the politicians in the US, in the Congress, they can move markets, whether it's going to be only quantitative tightening stemming from the fact that the US that the debt ceiling in the US will be lifted and Treasury will go on the borrowing spree, or will they move further and actually cause any lasting damage. But before doing this, traditionally, let's start with top news on Monday morning, and the top news is that we had a slight cooling on the markets towards the end of last week, although already on Monday we see some deep buying, so it looks like the momentum of the market is still there. The cooling was the effect of a couple of things. Among others, as you can see on the picture here, there was a ruling on Apple, which wasn't strictly negative, because the court said that Apple is not a monopolist. However, they didn't like some of their practices in App Store, which are very lucrative for the stock, and therefore it could have some ramifications for the company if they are not allowed to use their power in order to collect hefty fees from developers. So we'll see which direction this is going to go to. However, on Friday the stock was dropping more than 2%, and yeah, so some air is out ahead of this Apple Day, which is tomorrow. Markets anticipated that there will be the new iPhones. Obviously, stock price was going up towards this event. However, this court ruling had negative impact on the sentiment. Furthermore, and I think this is actually more important, we had some rumblings from the Democrats camp regarding higher taxes. So if you look at the markets since Biden took office last year, you can see only positives. So you obviously had these stimulus checks which stimulated the economy, which had people buying stocks and cryptocurrencies. Secondly, you had hopes of this huge infrastructural package, which we are going to discuss today, and then again, all the negatives that were in the campaign did not materialize. So we didn't see any higher taxes, at least for now, and we didn't see major regulatory changes that would actually influence stocks. So if this happens, if Democrats actually, if this leftist wing in the Democrats camp actually, if they prevail, and if we see higher taxes in the US as a means of financing for the package, then obviously this is going to be a problem for the market. So this is something definitely worth watching, and we'll discuss this in a minute as well. All right, but let's start with what we saw last week. Technically, the event of the last week was the ECB, but the bank failed to impress the markets in any meaningful way. As expected, they signaled that they would lower their PEP purchases slightly, as you can see on this chart from Nomura. This means that these red bars are slightly lower. This is this pandemic program that it's about to last until the end of March of next year, and right now it seems that it will not be extended. However, that doesn't mean that ECB is going to stop printing, because they still have the APP, and the expectation is that this APP will be increased, so that even though the QE, this pandemic QE, ends in somewhere in the spring of next year, and despite this fact, this overall QE will only be slightly affected and will be reduced very slowly over time. So this is the market expectation, and the ECB wasn't hawkish enough in order to prevent to change the market dynamics. So if you look at the euro dollar, it actually the dollar already has some very decent momentum after this period of weakness following the Jackson Hole meeting, where Powell was also very dovish. There was a chance for the euro dollar to actually start and extend this move higher. However, we saw a very clear reversal here at this previous peak, and therefore it looks like this double top is embedded into this larger downward scheme, and therefore I think the baseline is that we test 1.17 again. So definitely the ECB hasn't done enough to prevent that. And if we look at the bond markets, the change also doesn't seem to be all that important. So basically there was a period towards the end of August, especially around this Jackson Hole, when you saw bond yield ticking up. Obviously it's still negative, but it's less negative than it was in August, whereas US 10-year is stuck at around 1.3, obviously positive but not changing. But if you look at the spread, which is the pink line, it's pretty flat. So from that perspective, it doesn't look like it's going to have major impact on the FX market. All right, so let's move on to the story of this week and the deep ceiling and the potential US bankruptcy. Why is that important? So basically, unlike in Europe or I don't know, Japan or most of developed countries, in US technically the government may not issue as much debt as they want, because there is something like a debt ceiling which was introduced in 1970, which is more than 100 years ago, and in theory it's about to stop the politicians from reckless spending and increasing public debt. But that's only theory, because as you can see, this debt ceiling was increased over 100 times already. So it doesn't work in the way that it was intended, but what it actually causes is some kind of political debate each time the ceiling needs to be lifted. So there is a political play around it, and sometimes this play may cause government shutdowns, because basically if the debt limit cannot be lifted on time, then obviously the government may not issue the new debt, and when they run out of reserves, they need to limit spending so they can remain solvent. So very often it has very few market consequences. So obviously there's a lot of media coverage around this, but historically the market impact was limited. This time it's a bit different, because last year the Fed was able to take advantage of the situation, and they were able to print a lot of money in the first and second quarter of last year. So the Treasury took advantage of this, and they increased their cash holdings dramatically. So this year, even though the deficit is very large, they were able to limit debt issuance because they were consuming their cash reserves. We discussed this in April and then also in May and June, I think. And what it caused huge over liquidity on the markets, because since they were not releasing new issues to the extent they would if shouldn't they have these cash reserves, all the bill holders were redeemed and they had to do something with their money. So the result was huge over liquidity, which obviously helps all the markets, stocks, bonds, commodities, because investors, they are stuck with money and they need to do something with it. So this is, I guess, the most important area which needs to be observed in this debt ceiling context. This is because, as you can see here, since the pandemic, even though the US has record deficit, the Treasury really didn't have to rely on the markets over the past more than a year, because as you can see, as I said, the Fed used the pandemic crisis, and they purchased tremendous amounts of bonds during this period because they were not limited. They said, look, we have a crisis, we need to intervene, and they, as you can see, they within 3 months they went on such a buying spree that the Treasury was able to take advantage of it over the next more than a year, and they actually didn't need the markets to finance it because the Fed was doing this. So obviously this has two ramifications. So first of all, the Fed does all they can to extend this QE, as you can see. So they ignored inflation, they ignored strong economy. The Powell looks for all the reasons not to taper. So this is the first ramification. Markets see this, and therefore the bubble grows. And the second ramification is that despite this, the Treasury is already running out of cash slowly. So if this shutdown, if this political crisis extends, and if there is government shutdown, then obviously their cash levels will become very, very thin. And when the debt ceiling is eventually lifted, and with the deficit being so large, Treasury will need to finance. We need to issue a lot of debt, much more than the Fed purchases monthly, and therefore the effects for the markets will be withdrawing some of this liquidity. So this could actually have the biggest ramifications for the markets, because since this over liquidity helped valuations, then withdrawing this liquidity technically could spark market correction. Therefore, it should be watched. There are a few more things that should be watched. One of it are disagreements among Democrats how to how to introduce this infrastructural package that they want to push ahead with this debt ceiling. There's this leftist wing spearheaded by Bernie Sanders, where they want a big package, where they want taxes on Wall Street, and if this goes through, that's obviously one negative for markets. Second thing is debt rating. As you can see, US has AAA from two agencies, but S&P, they lowered US rating 10 years ago, and actually that was also around the debt ceiling debate. So right now you can see the Fitch has negative outlook, and if the situation is not resolved relatively quickly, there is a risk where the Fitch would lower US rating also to AA+. And even though obviously the US they still have reserve money, it's not like they're going to see huge outflows, but that would put US in some kind of uncomfortable situation where the composite rating would already be not AAA. So obviously from the market's perspective, this is a risk for sure. As you can see, 10 years ago when the S&P lowered the rating, this actually promoted market correction. So this is something definitely needs to be watched. And then third, can US actually go bankrupt? Well, technically they can, because if the debt limit is not lifted and they run out of money, they will not be able to for instance pay interest on their debt. But then obviously everyone would know that it's only a technical issue, so it's not like they're out of money and it's another Greece. It's not a situation like this. But obviously still that would probably cause a lot of uncertainty on the markets, because no one ever expect this to happen, and therefore all this collateral that consists right now of US treasuries will be under question, and there could be some kind of market freeze like we saw in 2008 during the GFC, where this uncertainty could really spoil markets. So I think it's very unlikely. I think politicians aren't this stupid, But in any case, this is obviously the most severe consequence of this debt ceiling thing. So at the very least, whenever this debt ceiling is raised, whether it's today, which is obviously impossible, but politically impossible, but whether it's today or whether it's in a month, there will be some kind of liquidity drain that could potentially affect markets. But like I said, there are other potential negatives that should be watched, like this higher taxes from the Democrats' camp, like this rating situation. Obviously, the most scary thing, although very unlikely, like technical default. Okay, so before we turn to charts, let's have a quick look at what is in store this week. And this is definitely the US data week. As you can see, today, as usually on Monday, it's relatively benign, but then Tuesday, Wednesday, Thursday, Friday, all important data releases, but especially inflation in the US on Tuesday. As you can see here on this chart, the latest data is for July, very high inflation, above 5%, and as you can see here, August, there is slight small base effect, but it's not very large. So from what you can see here, for the next few months, the base effect doesn't change all that much. So unless we can see some disinflation here from fuels and used cars, inflation may actually persist at these high levels. So if it does, obviously it puts the Fed in uncomfortable situation. So obviously they ignored the spike, but if the inflation persists here, more and more voices will be pushing them to do something about it, even though, like I said before, they don't want, because they won't help Treasury finance huge deficit. Okay, so let's take a look at the markets. So far, I think I would say so far so good. So we discussed euro dollar, where this return to 117 seems to be the baseline scenario for now. That has ramifications for precious metals. As you can see, gold, they were able to recover from the slump in early August. However, once again, this 1830 area stopped the bulls, and for me, this market is, whenever something like this happens, a drop below below 1700 is probably an opportunity for a speculative buy. However, it doesn't look like any significant trend is shaping up here. When we look at US markets, we once again test the 50-day average, and so far all the tests were positive in terms of maintaining this upwards trend. So we had a small profit taking last 4 days, but already on Monday, as you can see, there is this buying momentum. And yeah, the Nasdaq remains very high, and on the DAX, as you can see today in the morning, we already have quite a strong reversal. Actually, this market is technically the weakest. This market is the weakest, but even though it's the weakest, we still had few such situations like here, where there was a consolidation, there was a potential breakout lower. So you could see, okay, maybe now we are going to see a larger correction, only for this breakout to be negated and the market went higher. And once again, we had this correction, we had this consolidation here, and technically we had a breakout, and it's still possible that unless the bulls can manage higher here, we could see finally a larger correction with another lower, but this zone needs to hold. And so far this Monday morning impulse seems to suggest that it might not be the case. So on these Mondays, be careful, because markets like to push higher, forget the last week and just push higher again. So unless this move today in the morning is negated, we can very well see once again a repeat of this situation. Okay, ladies and gents, thank you for your attention. Hope you have a good week. Stay with us in the news section, where we try to cover markets for you with all these US data releases, all the big market moves. You have this covered either in Next Station Mobile, and we see each other next Monday. Have a great week. Bye.